Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. Thursday, August 8th. That's right. Is that right?
You had to look down for that one.
No, I knew it was the 8th because tomorrow's the 9th, and I know tomorrow's the 9th because it's Friday.
Correct.
We're going to Saratoga. Did I just dex myself?
You doxed yourself, by the way.
It's market call. It's me and Dan. That's it.
That's it. Just the two of us.
Amanda's on vacation.
Yep.
Jacob flew up from the Carolinas to be here because Hockman is in
Martha's Vineyard.
Doing
a show.
Then he's going to Montauk, I think.
Yeah, he's going.
Big shot.
Yeah, he is going there.
Danny Moses is here, but that's for later.
Will you put any a few wagers on the ponies when you're up there?
Sure,
in Saratoga?
that's the whole point.
Is it the whole point?
Yeah, you go up. It's like going back in time.
How do you feel about taking gambling risk versus trading risk?
Same thing.
You think it's the same thing?
I mean, I think in a lot of ways it's very similar stuff. I mean, investing is obviously its own animal, but
Correct.
you know, the mindset between trading and gambling, it's all about risk management. It's all about leverage and all those different things.
Right. But the instant gratification with gambling is kind of, it's kind of fun. Like, right. Like,
why don't sports gambling to me is dumb.
But think about this. I mean, my point
horse
is
racing is
my
sport of kings.
Yes. But, when I was an active trader, like back in the day, sitting on a desk, I never gambled because I felt like that's just doubling up on the sort of, it's not the sort of feeling I wanted on a Saturday afternoon when I'm watching a college football game because I did that Monday through Friday.
Some people can't watch sports unless they have action on it. I am not one of those.
So here's a
people.
question about trading. Did you get more happiness out of winning trades when you closed them out than
I know what you're going to ask.
Then the kind of just disgust about making a bad trade?
It's the lows always outweigh the highs for me. Yeah. Always.
Well, you know that there's always a low coming after a high. It's kind of like that
ebb and flow.
Yeah, it's that what have you done
No,
for
but
me
your
lately?
point is like I
got you.
The downs, just the depression of losing was always worse than the highs of winning.
But it's like anything. You got to pick yourself up. You got to kind of
dust that shit off.
No, you got to reevaluate what went wrong and why, and try not to make the same mistake. That being said, we get questions all the time about trading, about risk management. Listen, I've been doing this since 1997. I still make some of the same mistakes that I made back then. Sometimes it's just ingrained behavior. You know what I mean? A little bit, but hopefully
anyway, let's throw the rundown up because it is again one of those
inside days. Baseball here,
what
bud.
BTFD is back.
Buy the dip. And if you the freaking dip, whatever you want to do there.
Oh, the F is a bad word.
Oh, it's freaking.
So BTFD is back. Consumer discretionary calamity.
Yeah, we got a few charts there.
Yeah, GLP-1. One dog goes one way.
You see what we're doing there?
See what you did.
Right. So Novo was down a lot yesterday after they missed sales estimates on their GLP-1s. Look at Lilly screaming today.
And screaming higher on the open, given but we'll see. And then if we have time, a little audience Q&A.
Why wouldn't we?
Why wouldn't we have time, or why wouldn't we do that?
Why wouldn't we do that?
Or both. So let's take a look at the SPX short term because a lot of movement. Yeah. Yesterday you had the late day sell off. You obviously see what we're doing here today.
All right, so let's go through that for a second, guys. So the last 2 days prior to today, we had late day sell off. Yep. So we had these markets that really felt like they were kind of making up some ground from Friday into Monday, but then they kind of lost it in the last hour and a half or so. Like when you think about this, we have similar price action today, right? As we did, the last few days. Yeah. I mean, what do you think the probability of a late day sell-off is?
I think that's what people yesterday. I thought it was very good, and we actually had that conversation.
We talked about it on market
today, and not so much. I mean, I still think we probably close higher on the day, but I think the trajectory. I think the die has been cast where rallies are going to be sold, and I think that's sort of what you're seeing. I'll say this as well, despite the fact that the VIX has been cut in half from Monday's high-ish, you're still talking about a 25 or so VIX, which suggests you're going to see some pretty violent swings still.
Yeah, let's pull up the 1-year S&P chart. We've been talking about that 200-day moving average is down there about like 5,000-ish or something like that. And if you just look at this range, you say to yourself, okay, we had that sort of precipitous drop. It looked very different than that April sell-off. That was 5.5% or so. Very different than the last July of 2023 into October. That was a series of lower highs and lower lows, and it took a while to get down 10.5%. 2%. So for us here, this all happened pretty quickly. Some of the stuff not having to do a whole heck of a lot with the U.S. economy and U.S. monetary policy, somewhat reactive, right, to Japan, guy. I mean, how much do you place over this last week? Because let's just bookend this a little bit.
Yeah.
Jobless claims today, not as bad as
Noisy,
people expected.
but yeah, okay.
Noisy, okay.
Yeah.
So we're rallying off of that. But last Friday sparked, this sell-off, which I don't know about you. I didn't think that July jobs report was horrible.
Well, the uptick in the unemployment rate is what's horrible.
Right. 4.3, is that where it got to?
4.1 to 4.3 is what scared people.
Yeah.
And then obviously that triggered what we've been talking about for quite some time. So, I mean, listen, again, it's not, I don't care about politics. I saw Steve Leisman on that day. He said historically 144,000 jobs created, or I think that was the number, has been a good, that's not really the point. The point is the trajectory of things and the arc in which the employment picture is going, and the commentary from all these different, basically retail shops and restaurants and different industries that we've heard suggest that things are slowing down. By the way, they should be slowing down. It's not an indictment of anything other than the fact that the market does have cycles. So I hear what you're saying, but again, it's the rate of change and it's where we are now compared to where we are at the lows in terms of the unemployment rate.
So let's just pull up a 5-year, if Jacob can do that really quickly on the SPX, because when I look at this, you and I were definitely in that camp where, you had that breakout. I want to say it was late 2023 above the late 2021 high. It might have made a brief new high in January of 2022, right? And let's just draw a trend line, Jacob, from the 2020 lows. That would be March, and you can connect it to some of that action we had in 2022 and 2023. I mean, the market's still in a fairly decent uptrend, no doubt about that, right? And every once in a while, folks will post these long-term charts of the last 100 years, and it makes a lot of these sell-offs look like little blips. And the point is that it's always lower left to upper right here. So when I think about these trend lines here, the uptrend, if he can do it from the 2020 lows, just drawing it from the 2020 lows, it gets you to 4,500, guy. The breakout level, I think, was like 4,700, 4,650 or something like that. That 200-day moving average we talked about at 5,000. I mean, just technically, there's still plenty of room to the downside just for a little correction.
Right.
We're not talking about a crash.
And that's the trend line. And it lines up, again, with time decay. With each passing day, that line gets higher. It lines up with sort of that horizontal line that Jacob's about to show you, which it all just sort of makes sense. It's not a calamity by any stretch of imagination, but it's a downdraft in what's been an uptrend for the last 3.5 or 4 years, which again is not, the other day we talked about it on Fast Money when Jeremy Siegel came out Monday and asked for a 75-point emergency rate cut. And I said, what's the emergency? The emergency of the market's down? I mean, markets do go down. Even in the best of bull markets, you do see downdrafts, and I think that's what we're in the midst of now.
It's interesting. So if you look at that period where we did have a downdraft from the highs in early 2022 to the lows in late 2022, and you just look at that move, and we were talking about at the time, very orderly, right? And definitely taking out some of the excess of late 2020 and 2021. Think about what was going on in 2022. The Fed were raising interest rates, right? So now, right as they're about to lower interest rates, September, maybe, I think the Fed funds was nearly pricing a 90% chance, guy, of a 25 basis point cut. So it's interesting now that you have, some trepidation about a recession and what would that mean for U.S. corporate earnings? Because at the end of all this is a chart of the price action of the S&P 500, which is a discounting mechanism, right, of a future earnings stream of the S&P 500 companies. Like, listen, if you had a retracement back towards 5,000, maybe that breakout level of 4,800, wouldn't that be like somewhat of a fairly, I don't know, cleansing sort of move?
That's what I would think as well. And I don't think, I thought we were going to see it in April. Obviously, it did not happen in April. And I think that surprised some people. And I still think we're going to see it now. That could still not be the case. The market might shrug everything off and we're back to the races. I don't think, though, that's the best for the market. The market just to sort of reaccelerate from here, I think it's just prolonging the inevitable. I think, to your point, we need some sort of cleansing move, which leads us to a question from Bill Fletcher, if you want to throw it up.
Sure.
How meaningful is today's jobs report to the overall market direction? I mentioned this because he also said that JP Morgan raised their second half recession potential to 35%. And I think that's the point. I think more and more of these shops are coming to the realization that there's sort of an inevitability to this, and it's not the worst thing in the world. Again, you hear recession, be like, that's a horrible thing. Not necessarily. it washes out some of the excess and it resets a lot of different things.
Yeah, no doubt. I mean, one of the things, this is Doug Cash just hit us. And I love this. So we're talking about the risk reward, or the feelings of risk on a winning trade versus a he said it's called biopic loss aversion. It's cognitive bias that suggests that for individuals, the pain of losing is psychologically twice as powerful as the pleasure of gaining. I think that's pretty interesting. All right. Speaking of losing, let's look at the NDX and NASDAQ 100, because on a relative basis, Guy, it went down a lot more than the SPX. We know there's some air coming out of the generative AI trade. I think you and I would also say a little cleansing of that would make a lot of sense, especially when you think about how some multiples got a little geeked up relative to what might be a CapEx cycle that moderates, over the last 18 months. A lot of these big companies, the platform companies, the hyperscalers, they just had to go aggressively here, because if they didn't, you had the opportunity just to be perceived as a laggard. And that's what held back Apple over the last year or so relative to the NASDAQ and relative to many of these large mega cap techs.
Well, I mean, there are a couple names that stick out. So why don't you throw a Dell chart up, because you mentioned it the last couple of days, and it's worth mentioning again. Dell has now round tripped the move since the spring, effectively. I think we were about an $85 or so stock in the middle of March, and here we are anywhere between 85 and $90 now. So that, by the way, as stock that traded up to, I want to say almost $180. So it's been cut in half, and maybe it's done enough damage where you could start to take a look. It's all about, I think, risk reward and trading opportunities, and you've flushed out a lot of the excess. So at least you understand, where it was, where it got to, and where it is again. That's one side of the equation. There are other names as well where you wonder what the floor is. Like we talked about SMCI over the last couple of days. I mean, it's bouncing today. I think it's up about 5% or so, and people will say maybe that's enough. I'm not so sure. I mean, I don't think, there's reason to believe there's still some downdraft here, especially if the broader market starts to give it up once again.
Let's be clear. That stock is going to retrace that whole move. Okay. Is it a great press on the short side? Of course not. The short interest there, the lack of liquidity, that sort of thing. But let's be clear. So go back to that Dell chart for a second. I mean, Dell has basically retraced that whole move. Dell is a very different company. We made the point, though. Dell has 22% gross margins versus this company that just saw them drop from 17% to 11% year over year. Dell has basically lapped that entire move. I want to pull up the NDX for a second here, Guy, because we talked about the S&P that I think at its lows earlier in the week was down 9.5%. At its lows, and it was a brief low in the NDX. Okay, Monday morning was down about 15.5%. When you look at that concentration that we've had over the last few trading days, it's not that impressive. You know what I mean? When you look at the way some of these individual names are bouncing today, you have the SMH up nearly 5%, Nvidia up 4.7%. And you'd say to yourself, well, how is this NDX not at 19,000, right? Let's pull up Nvidia for a second here. We talked about this earlier on our Fast Money call. This looks like a blip, you know what I mean? Like this up 5% relative to the sell-off here. So again, thoughts on how far the bounce can go, the buying of the dip. So look at that today's action. Just move that out a little bit, and that did retrace on that Monday morning gap lower, Guy, the whole gap that we saw from May.
Yeah, I think it got, I don't know if it printed $90 or what was the low on Monday? Give me a second here. I'll take it. Like 92 or so. So, I mean, you filled the, listen, we had been saying for a while that we thought Nvidia would fill that gap that was created. That's what happened. The bounce has been okay. I mean, it's going from 92. Where's it now? Like 104 thereabouts.
Yeah.
I mean, okay. But is it just a blip, to your point? I think that's exactly what's going on. I mean, I could make an argument, on the worst case scenario for Nvidia, and it's not ridiculous to think, that this stock could trade back down to, I don't know, Dan, what was the low we saw in April of this year, split adjusted 75?
Yeah,
so
why wouldn't it? If when we get to their earnings, if they just come in line, you know what I mean, with like a a guide that's just in line, the stock should continue to go lower. It's funny, and I'm just going to bring this up, and it might get you triggered a little bit. But somebody sent me. I'm not on the Twitter basically at all these days. I'll pull it up once a day and see what comes up. It's always, I swear, it's always an Elon tweet. I don't even follow them, but they're just trolling me, I guess. Somebody sent me a tweet the other day, and it was from I'm just going to use his name, Barry Ritholtz, which you've known for a while. And it was one of those tweets just to get a bunch of, here's a guy that you never hear from other than snarky tweets or anything like that. And he was like, all the pom-poms out for the guys who were calling, you know what I mean? Who missed the 200% rally, but got the 9% sell-off.
Who was that directed at?
I don't know. But the whole point
Good for
like
him.
the whole, I know, but the whole point was that all the trolls then get on there and he gets a lot of engagement. And I just love it because that guy, I got no beef with him. I'm sure he's a nice guy, as you like to say, guy.
Yeah.
But it's just so funny that these guys, like, they spend a lot more energy trying to troll people on Twitter than probably doing the stuff. For us, like pointing out the fundamentals of these stories and the psychology of these stories, that's what I like doing. You know what I mean? I enjoy that. And we get a lot of feedback. A lot of people, they find it pretty helpful. So again, not a trading service here, people, you know what I mean? But we're trying to do very good analysis.
Well, if you can withstand, I mean, Nvidia, when it was trading $92 earlier this week, was down approximately 38% ish, if I would do the math, from the all-time high on June 20th. So if those moves are insignificant and it's just an investing thing, I'm just going to own it for the majority of my lifetime, then you probably shouldn't be watching Fast Money or tuning into shows like this. If you're looking for, directional bets, opportunity, you're trying to be somewhat strategic, then those things come into play. I mean, that's the difference, right?
Yeah.
I mean, if you're just in the market and I'm not selling anything for the rest of the rest of my lifetime, because these moves don't matter over the course of time, the market just goes up. That's fine.
Yeah.
But there are moves to the downside, as we pointed out a number of times.
You and I, we bring this up all the time. I mean, it's great when you're in a mania and it looks like that things are only going one way, you keep averaging up. But when the story changes, and that's one of the things we've tried to really talk about, what is the potential for, some sort of deceleration in the growth of a company like Nvidia that has been a one-way train. They're the sole provider of these high-end GPUs. I think we just saw the first kink in the armor here when they're pushing out this Blackwell. And, we've been making the point that 40% of their customers, 40% of their revenues come from 4 customers. It's Microsoft, it's Google, it's Amazon, and it is Meta. And at some point, if they're not able to show the monetization, the CapEx is going to slow. And so understanding those dynamics and understanding that the server makers are falling apart. We just showed you Dell. We just showed you SMCI, that's Supermicro. Any of the competitors here, AMD, which is that's gotten absolutely killed. Micron, the memory maker, has gotten absolutely killed. So what do you think comes next if the story starts falling apart? And I'll just say the last thing is that if you're averaging up, then you're probably averaging the way down if you haven't understood the story. And then that's how you lose a lot of money.
Well, I think that's exactly right. And you wonder, like, what is the last person standing or last stock standing? So let's pull up SMH, because I think as of, I want to say, a couple days or so ago, Nvidia is now 19.5% of the SMH. Taiwan Semi is 14.5%. So you can do the math. You throw Broadcom and Texan in, and you're talking about 45% of this ETF. I've thought for a while, so that we traded down through the moving average, we're back above it. You see the gaps on the upside, then at some point it'll probably be filled. However, what I've thought incorrectly for a while, but now it's starting to seem more likely or potentially likely, if you do a longer term chart, Jacob, you'll see what I'm looking at. We did have prior double tops in this thing around 163 or so. And by the way, if you go back and look, you saw a pretty significant downdraft on the back. So if you were to put your cursor to the second double top, Jason, in the middle of this chart, now go over, down, go down, 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 right there. Okay, so that was the double top. And forget about what's happened since. You saw a pretty significant sell-off. Now, it doesn't look that way given the move we've seen. But trust me when I tell you, those 3 months were pretty dicey. I think we're headed back down to those levels at some point.
Yeah, let's go to a 1-year chart for a second, the one we just had before. What's interesting on a near-term basis, guy, that panic low that we saw on Monday, it's basically you can draw a line to that
Same
low
as
that we saw in April, which has taken off a lot of excess if you think about it, right? Because a lot of the names are just falling by the wayside, and it's really left on Nvidia and Taiwan Semi. At the lows on Monday, it was basically 29%. Is that like a Fibonacci number or something like that? 29%?
No. No,
what
it's
are they?
38.2,
No,
61.8,
I never learned that stuff.
and 50%.
I was a French guy in high school. I never took Italian. So
they teach you that in Italian?
But I'll tell you this, it closed above its 200-day moving average that day on Monday. Listen, there's that gap that you see from last week. It gets you to like 230. It's another $10. I don't know about you. I'm not trading the SMH for $10 here.
No, it's not that. Yeah, and I'm not suggesting anybody should do it, but I think it gives you a good sort of understanding of what the components are, where we've been, where we are now, and in the context of where we could potentially get back to. The other thing that I think is interesting are these banks, which until the last couple days, I mean, they fell off a cliff over the last, from middle of last week until earlier this week. And it made sense. We have had multiple conversations of Bank of America and different things. But the question is, was this sell-off in sort of the KBW? We can look at some individual names enough, or, is this just a bounce on the way back down to the moving average, which by the way, that's what I think is going to happen.
All right. So Guy, explain to me, yields down, good for the banks, yields up, good for the banks. How does this play out?
Well, people that, again, depending on your dogma, whatever the yield curve steepening, or, the reality is whatever tailwinds are provided by interest rates and yield curve differentials are more than mitigated by a slowing economy and a slowing consumer.
Yeah.
And I think that's the underlying thing. And, there's a bunch of notes out today about credit card debt at record highs and overall consumer debt at record highs. I mean, all those things are going to play in at some point.
It's pretty fascinating. The Bank of America chart, this stock to its lows on Monday from its recent 52-week highs, I'm going to say a couple of weeks ago, was down 20%. And again, the Buffett thing didn't obviously help. You know what I mean? And listen, let's be frank. If he's out there selling stock and he owns so much of that, he's going to continue to sell that stock, right? And so it's going to continue to weigh on the shares there. It is interesting, though, Guy. Even JP Morgan was down 12% in that 2-week period. So I think those just became really crowded trades, and it became this universal sort of thing when the Fed signaled that they're going to be lowering interest rates for a name like Bank of America that had so much trouble, right? When the rates were going higher with their mark-to-market, treasury holdings and the like, you would think that it gets better down there. It's amazing, though, to the penny, Guy, that 200-day.
Let's look at, and I don't use the term, but the 7 stocks that everybody's focused on. We can look at, where they are today in the context of overall things. I mean, some interesting moves. We've talked about them. They've all been under significant pressure. They've all had decent years, ex Tesla, which is still sort of struggling. Is there anything that sticks out to you here? I still think the potential canary in this coal mine, forget about Nvidia for a second, is Microsoft.
Yeah, I mean, listen, Microsoft is going to have to show us when they report in October that they're getting better adoption of Copilot, right? From some of their big customers. And, who knows? I mean, the jury's still out. We've highlighted a few, CTOs over the last month or two who've talked about like some of their early trials of the technology is not something that's gaining them a lot of productivity. And it's not really kind of worth the increased expense. When I think about Amazon, I think about Google Cloud, and I think about AWS. Some of the results that were based on the uptake in services, AI services on their platforms was just not that great. And that's why those stocks kind of sold off after, to me. And I just want to go back to Tesla. And I know you guys, think I'm just, got too much of a, what for Tesla. Look at this thing down 20%. It's still down, about 50% from its all-time highs made in late 2021. And for those people who think that a great story with so much positive sentiment, can't go the opposite way if he wants to pull up, a 5-year. I mean, Tesla is a cautionary tale of way too much exuberance, right? When it comes undone, like it just comes undone. I mean, you can draw a line from that 400, you can attach it to all of those, those highs over the last 2.5 years. They're all lower highs. We made one new high. That was just a couple weeks ago or something like that. But that was like born into a grave, as far as I'm concerned, based on everything that they said on their last call and the way that they've seen a deceleration in their core product. And the fact that they're telling you, don't look here, look here at humanoid robots and robo-taxi and the like, that's fugazi, man. So to me, I would expect this thing to go back and make lows from April.
Yeah, I don't disagree. I mean, look, we had a show a couple months ago on Fast Money. I think Tesla was trading about 175, and there were 2 analyst calls that day. One had a $125 price target. Another, I think, a little north of 200, but not much. And Mel said, "What do you think?" I said, "I think what's going to wind up happening is they're both going to be right." I thought we'd trade up to 200, fail, and get back down to those levels, 125-ish by the end of the year. I didn't think we were going to 240 or wherever the hell we trade. Where did we get up to? I think at its high, 260.
Yeah, 260.
So I didn't think it was getting there. But, that's what happens. By the way, that 260 level was exactly where we topped out back in December of last year. So I guess in terms of levels, it made sense. But again, to your point, if you go back in time and look, since it's made its all-time high in the fall of 2021-ish, this stock has been a loser other than a couple bounces along the way.
Yeah, I guess just I'd say this: there's unique excitement around this story relative to Elon and the like here. But this is the way some of these stories go. When you start missing numbers, you start guiding down, you start seeing multiple compression. We've used my friend Dan Benton's 20 rules of tech investing that he came up with in the early 90s, and they're all still very consistent. Guys, all right, this was the thing we teased as consumer discretionary calamity. Let's just go through these names. Walt Disney. I almost
can't get out of its own way.
I called it Walt Disney.
The Walt Disney Company.
Yeah.
I think that's what they call it.
Let's look at a 1 year. Let's look at a 5 year, and let's just rip through these. That's the 1 year. Whoa! Look at that Head and Shoulders. Those two gaps is pretty fascinating. Let's go to the 5 year really quickly. Look at that. It's literally flirting with those sorts of COVID low levels. Now let's go over to Starbucks. This is one that obviously that's the 1 year, also flirting with 52-week lows. Let's go to a 5 year on that one, flirting with a huge level, guy. You break that, there's no support. Back to the COVID lows. And then let's go to Nike. All right. You see that gap. You see what it's flirting with. It's trying to consolidate there. There's no even effort to fill in that gap. Let's go to a 5 year. And again, on its way to its COVID lows. What do you think the common thread here is?
Consumer, the weakness of I mean, they're all company specific to a point, but overall discretionary spending, right. And they're all up against it without question. And by the way, if you listen to the commentary, they all pretty much say the same thing in a different way. They're seeing the slowdown as well. Disney is, throw that up. I mean, you talk about timing. Nelson Peltz announced he was out of his holdings. If you go back to
about a few months ago.
No, but it was when it was at its high. I don't know how. I can't see the time.
120.
Got to $122. Yeah. If you do another chart, it illustrates it a lot better, Jacob. Anyway,
do the year
the timing was there. You go.
Yeah.
So that move up to the moving average was that's when Nelson Peltz announced he had gotten out, and it's right back down to the levels we are now. I mean, theoretically, this should be support. But there's not a lot of there's no compelling reasons other than technical to be long any of these stocks.
Yeah, and I want to throw one more. I mean, he can throw up Lulu while we're talking about this, because this was
a little bit of a bounce here. I think it's up. I think 3.5% today. But
keyword little.
It's amazing.
Horrible. But I want to go to Home Depot, and I want to get your take on this, because could you put Home Depot in that consumer discretionary?
100%.
So look at this thing on a 1 year basis. It's flirting with that 200-day. That's purely technical. We can talk about valuation in a second here, but here's the 5 year. And so to me, it's interesting that there's so much focus, Guy, on mortgage rates. You know where they come down to? You know where they are right now? 6.55%. Right?
I think they're focused on the wrong. I've said this for a while. I mean, I understand why people will look at home builders and names like Home Depot and say it's all interest rate sensitive stuff, and I get it, but what I've said for a while is, as much as it's about interest rates, it's more about the employment picture, because if the employment picture starts to deteriorate in the way that I think, that's what's going to start to unlock all this sort of, this gridlock we have in the housing sector, because people are locked into their mortgages and are not selling.
Yeah.
That inventory will come on if people unfortunately start to lose their jobs. And that, to me, is the existential risk to all these trades.
Yeah. The last thing I'll just say about Home Depot, and you might say relative to itself, this is not particularly expensive, but earnings growth this year expected to be about 1%. Next year, about mid single digits and low single digits. Revenue growth, it's trading about 23 times this year, 21.5 times next. Now, not horrible, but there's no growth there. You know what I mean? So how do you get to an acceleration of growth when all the fears right now are about the unemployment rate going higher, right? And economy that's weakening? I just don't, this is probably mispriced. And you could say to yourself, well, it's kind of at a market multiple at 21.5 times next year. But I don't know, like you and I've talked about this a lot. We talked about it in Fast Money and Market Call yesterday. Expectations, and FactSet's got this, 11% this year over year, EPS growth 14% next. Seems kind of rosy to me.
Gregory C's asking, will this rally hold today? We talked about it earlier. It feels like one of these days where it's probably going to hold. Yesterday felt different to me. Today's a little bit, it seems to be on more stable footing for now, at least. But the overall question is this entire thing going to hold? Was Monday and Tuesday, Monday enough, or is there more to go? And I think enough damage has been done where, you're going to see these violent counter trend rallies in what appears to be a market that, at least for now, seems a bit broken to me.
Yeah. So as we get into this Jackson Hole, August 22nd, Fed symposium, and then we know, I think it's September 20th or the mid-September is when the next Fed, here, I'll pull it up, when the September meeting is. Listen, we focus on this Jackson Hole thing. It's September 18th. Why? Well, over the last, 20 years or so, there's been some kind of indications of a shift in monetary policy that happens there. There's not an August meeting. So if we have a 10-year guy at 4%, we have the 210 spread, which is, basically, what is it? 4.5 basis points. Okay. So do you think the Fed is likely to signal something, kind of that September is maybe 25, like the emergency stuff is cut off the table here, right? That was just early. So like, what do you think equity investors want yields to do right here? What do they want?
Well, they think they want yields to go lower for obvious reasons. I mean, we've heard that over and over again. Quite frankly, I think the most bullish thing for the market would be for the Fed to do nothing and just sort of just let this thing run its course a little bit. I'm in the minority there. I totally get it. But to answer your question specifically, I mean, the market been conditioned to believe rate cuts are this elixir that's going to solve all the problems. I'm not necessarily sure that's the case.
Yeah. Again, it's interesting that the most volatility we had in stocks to the downside was when rates were falling precipitously. All right, let's go to a story near and dear to my heart. Let's look at these GLP-1s here, guys. So yesterday, it was kind of surprising that the maker of Wegovy, that would be Novo Nordisk, they missed their sales estimates. You know what I mean? They saw a major deceleration in year over year sales growth. Stock was down, I think at one point, maybe, I don't know. Let's see a 1-year chart on that. It got down, I don't know.
Well, I think yesterday got down to 118, I think.
Yeah.
Ish, if I'm not mistaken, right?
So the earnings growth, guy, this is pretty. So 31% year over year last quarter, the March quarter. The quarter just reported 3% year over year growth. And when you think about that, maybe it was a tough compare. It was up 50% in that quarter last year, but expected 20% growth. The current quarter, 32% growth. Listen, I look at this as trading at 37 times this year, 30 times next, expected to have earnings growth of 25% in the next 2 years on sales growth of about 26% next year or this year and 21% next. Is this stock too expensive when you consider all the competition?
Well, that's exactly right. Competition is coming, I think, in the form of a lot of different companies. They're all sort of chasing the same thing. I mean, that's the inevitability of a lot of these companies that, your margins are my opportunity. And I think you're seeing it with the GLP-1. So it makes sense that, these stocks have given it back. By the way, I thought Lilly would give it back a lot longer, a lot sooner than it has, quite frankly. So, and here we are. Now, with that said, although the stock has bounced 7.5% today, I'm saying to myself, that's off a stock that was $965 in the middle of July. Is this a bounce or is this the beginning of the next leg higher? And I think that's what the market's going to try to figure out.
Yeah. So Lilly's kind of interesting, and it reminds me a lot of Nvidia. So this year, Lilly's expected to have earnings growth of over 100%, and the stock looks cheap. You know what I mean? Relative to that growth on the current basis, it trades Lilly now 61 times expected growth of 117% or something. Same thing happens though in Lilly that happens in Nvidia. It's a major step down in growth. 40% expected next year in earnings growth, with sales growth going from 26% this year to 23% next. And then I look at it trading 43 times. So this looks actually more expensive than Nvidia on the out year number.
And just in terms of, if you look at where it trades in terms of market cap and what their revenues are, and then compare it to a Merck who's about, I don't know, maybe one half the market cap ish.
Yeah.
But it's going to do maybe 20% more revenue. I mean, you can start to understand how expensive these stocks are. We got one quick question here before we sort of 5,000. Dutch Bros, which is down significantly today. It's already traded about 18 million shares, which is 6 times normal volume, which suggests we'll probably trade 10 times normal volume today. It's flushed out. It was rich. It looks like we're getting down towards those sort of May lows at $27 range ish. I mean, this is one where that's Eli Lilly. Just pull up BROS real quick. This is one you can take a shot, and that's on the back of a question we got, I think, from, hold on. This is from Compounding Capital.
There you
so
go.
there you go.
First of all, Compounding capital. You just got Guy to say a term that he just would never say
Bro.
normally, bro.
Yeah, I don't say
You
that.
hate that when
Yeah,
someone bros you. You
that
know what
is
I mean?
you know, my bros, it's like,
Yeah.
yeah, no.
But this is a company, Guy, Dutch Bros, that looks like it has the multiple of a tech stock, you know, and they're expected, I don't know, it's trading like 76 times this year, 64 times next. And if you look at what's going on in Starbucks, if you can't tell me that they're taking share from Starbucks, then I have no interest in the stock whatsoever.
Now, but I mean, at least it's at a level. You have a volume day.
Yeah.
You see what those prior lows were. I mean, this is
You
not
just
a
mean
fun
short-term trading.
Yeah, for a trade, I think this is interesting.
All
Dan.
right. All right. Well, listen, this was interesting. Let's do a little housekeeping really quickly here. Market Matrix, Guy. We launched this a little over 2 months ago. Really excited about it. It's basically we curate 10 stories each day of the top business and market stuff. We put it into a large language model. It gives us a little bit of a summary, which is really giving you a summary. We put it into a voice bot. We call him Brunston under 10 minutes each day, drops shortly after the close. Go find it in your podcast store. It's MRKT Matrix. Follow it, share it.
We're like 3 months into this thing. It's amazing.
It's exciting. We like it here.
We'll be on Fast Money tonight.
Oh, great pod dropping tomorrow on the tape podcast.
Yes,
very different than
Danny
what we
Moses
do here.
is working on it right now,
and we have a guy named Dave DeBuscher.
No.
Yeah.
That's Dave DeBuscher's the father.
Oh,
it's Dennis.
Oh, sorry.
That's right. No, but you know, Dennis,
Dave was a stud.
He was.
Yeah.
He was a two-sport athlete. He got drafted in both the NBA and Major League Baseball.
Sorry, Dennis.
That's so good.
Big shoes to fall, you know.
No pun intended.
Okay. All right.
Dave DeBuscher, I think, was traded for Nate Bowman, if my memory serves.
I'm sure
Howard Komives was in that trade.
I'm sure it serves correctly. Listen, drops tomorrow in the podcast store. Go find that, rate it, review it, share it. That's how people find the pod.
See you later,
Thanks,
peeps.
everyone. Bye.